Thank you for tuning in. I had a great question on the course about how to pay yourself. This one is very specifically for our LLC owners. Again, how you pay yourself depends on the entity. So we're going to talk specifically to our LLC owners, our single members, and our multi-members, or basically people that if you're in a partnership on an LLC. So there's three ways you're going to be able to pay yourself through this LLC. So one is going to be draws. Draws are essentially money that you pull out in anticipation of the profits or the distributions at the end of the year. Draws are great because we can set these up on a weekly, a monthly, whatever works for you basis. It can be a set amount. We do want to anticipate what the company is going to make at the end of the year. So if you're anticipating your profit's going to be $100,000 and you're a single member, try not to draw more than $100,000 because whatever you draw above that is going to be treated essentially as a shareholder loan or a loan that the company has made to you that you need to pay back. So the amount that's distributed, the amount of profit at the end of the company, again, LLC being a pass-through entity, is what you're going to receive and what you're taxed on at your rate. LLC does not pay tax. The second way is guaranteed payments. These are very specific and you need to designate that it's a guaranteed payment. Guaranteed payments are deductible as a salary or a payroll expense for the entity, so you get to write that off, but it is subject to employment taxes for you, including the self-employment tax. So you got federal, Medicare, Social Security. So if you want to do guaranteed payments, that's fine. You can do that multi-member, obviously not a single member, but in a multi-member, you can do the guaranteed payments. You can set that up weekly, bi-weekly, monthly, whatever works for you. And that is a deduction for the LLC as a payroll expense. But again, you are going to pay the payroll taxes on that item, so be aware of that. The third is just straight distribution. Whatever the company makes is going to be distributed to you. This is on an annual basis, so if you're a single member or a multi-member, both of these work. If you don't need the salary throughout the year, let's say it's a second, third, fourth, whatever entity for you, whatever the company makes is distributed out based on the equity. So if it's you and another person 50-50, company makes 100K, you get 50,000, he gets 50,000, he or she gets 50,000, you're both taxed on the 50,000 pass-through entity. The distribution, again, in line with the draws, so 1 and 3 are kind of related. If you do need to make money throughout the year, which I highly suggest you do the draws, do your draws, and then you can balance out at the end of the year against your draws. So if you anticipated 100 grand, you took 100K in draws, but the company actually makes 150. End of the year, that extra $50,000 you can leave in the company, you can take the 50K, whatever, it doesn't matter, but the company made 150, that's what you're gonna be taxed on. So thanks for tuning in to CFO AF explanation of how to pay yourself on an LLC.